You're willing to lose 15% of your wage. That makes me want to cry, Joe.
Hi, my name is Joe. I'm 22 years old. I just graduated over the summer and got myself my first full-time job 4 months ago.
Welcome, Joe, and welcome to Your Money Matters, the show that enables you to make better financial decisions, brought to us by First Abu Dhabi Bank. So, first job, how can I help you today?
So I figured with the cost of living going up, I could use some financial advice as to how to manage my money. You know, it is always useful to know where my money is going to and how I should be spending it.
So tell me a little bit more about yourself. What's the first job and how did it feel when that first wage dropped into your bank account?
So the first job, the one I'm working at right now, is in corporate services at a law firm. And as soon as that first wage dropped, it was a bit overwhelming since I didn't really know what to do with the money that just dropped in the account. But I soon realized that it's easy to manage where those bills would be going to.
So that's interesting. I mean, many people with their first job, as soon as that money hits their bank account, they go, you know, all out, spend, spend, spend. You're already beginning to focus on where your money's going. But tell me, where is your money going?
So the most obvious thing is it goes straight into my rent and my utilities, you know, my living expense. And as soon as that money hits the account, I'm quick to separate that money into the rent and living expense to kind of get those bills out the way.
Okay, so what's the kind of ratio of a percentage of your wage? What are you spending on utilities?
Right, so that directly goes to 50%.
50%. So the other 50%, the disposable 50% then, where's that going?
So for the other 50%, I ideally would want to split it 20-30%. So 20% of it I'd use to spend on entertainment. You know, that's for me, how I treat myself. And for the 30%, I aim to save that money.
Okay, and are you successfully saving 30% of your wage every month into your savings?
I aim to, and some months it goes more towards like less than 30%, like 25% I'm managing to save because of unexpected bills.
So tell me about your unexpected bills then. How much are you spending there? Are you tracking this right now? Because there's an interesting point here.
And for the unexpected ones, no, I don't really track them because I never really expect them, even though they happen often. You know, that's like one of them things where it's like you just don't know when they'll show up.
Well, there's an old phrase which is expect the unexpected. But if you look at unexpected expenses and then look at that from a 12-month perspective, divide that by 12, that'll give you a monthly figure. So you add that to your expected bills, and then you can look at your savings. Because right now you say it's 50%, but you don't actually know if it's 50% or not. So you're splitting 20-30. Let's say a good month, 30% is going into your savings. What are you doing with that money?
So with that 30% that I hopefully managed to have saved and left untouched, I go ahead and I separate that even further as halves. So I take that 30% and use 15% of it as just pure savings that I never touch. And with the other 15%, I use in a trading account, so in trading stocks.
First question, do you have an emergency fund?
I do not have an emergency fund, actually.
Okay. So when you look at that savings account, think about what you need to survive for 3 to 6 months. That's the first thing. You want to put that's your rainy day fund. So if we're looking at that savings account, that's there. The next thing is then what can we think about putting those savings to better use so they don't just sit in a bank account. So before I come back with what we're going to do with the savings, tell me a little bit more about the trading. Like, what are you doing with that?
Right, so the trading is just something that I tried to get into over the past year. I was on and off for the past year, but I really tried to get more involved with it over the past 6 months. And I focus more on short-term trades. You know, that I'm trying to make some of that extra cash, you know, quite on a short term.
Okay.
And it's been going okay for me. You know, some months it's in the red and some months it's in the green.
So some months you win, some months you lose. I'm guessing what you're trying to do is find a stock that you think is reasonably cheap and sell it at a profit. And you're trying to do that in a short space of time, a week, 2 weeks. That's an interesting one because that's kind of get rich quick.
That's fair to say that.
Yeah,
that's actually exactly what's going on.
And you're not alone. So many people out there right now are really enticed by the idea of get rich quick. The reality is that actually over the long term doesn't actually work. For example, you say sometimes you're in the red, sometimes in the green. Where are you right now?
As of this moment, my portfolio is red.
Your portfolio is. I love the fact you were 22 and I have a portfolio. I mean, that's actually amazing.
As a whole, my portfolio is in the red.
Yeah.
But because it it's never really a significant chunk of my actual money, and it is money that I've dedicated purely for trading, then I never get bitter over the fact that my portfolio is red, since I see that as an opportunity for me to learn from my mistakes.
Well, I mean, that's interesting because you're kind of investing in yourself. So I'm okay with that. However, you say when you talk about it being a significant chunk, it is actually a significant chunk of your savings. About 15% of everything you earn is going into short-term trading. A lot of research has been done in this space over the years, and if you take a step back to a slightly less aggressive passive income, over a 10-year period, which I know, particularly when you're in your first job, will seem like a lifetime, but if you invest in something such as an ETF, that will perform much better over 10 years than this up, down, up, down, up, down, up, down, up, down. And it's really super important for you to kind of focus on tracking that up, down, up, down, up, down, up, down. Because do you, over the course of the 6 months, a year, 18 months, 2 years, are you in the red? Are you in the green? And over that period of time, did you make more money? Because in fact, you may have made some money, but still be way behind inflation. Whereas if that money had started going into a different investment vehicle, you may have made more long-term money over that period of time.
That actually sounds pretty intriguing, but I'm trying to figure out, how do you mean as in terms of like a better investment vehicle? So you mentioned ETFs.
Yeah.
Could you elaborate on that?
So ETFs are exchange traded funds, and these have grown in popularity over the years. And these are a basket of stocks and shares, equities that are available. Many banks offer them, plus other financial institutions. These are, for example, your big name stocks that have performed over many years, that have a really good track record on the stock market. And any market is going to go up and down. But if you look at it over a 10-year period, they will always offer you a better return than if you win, lose, win, lose, win, lose, win, lose, particularly if you've got no idea about what you're losing.
The reason why I never really thought of long-term investment is mostly because of that 15%. I was never really afraid to lose it. That was money that I was in a way willing to lose.
You're willing to lose 15% of your wage. That makes me want to cry, Joe. Now, look, disposable income is one thing, but burning income, that's a different matter. Now, what I want you to think about, there's nothing wrong, and again, you're at the start of your journey. So what I like is the fact that you're willing to explore avenues to make your money work harder for you. That's really good. But 15% is a hefty chunk. If you're going to play, then let's bring that down to about 5%. And then let's move back into that 10%. Let's move that 10% back into your long-term saving plan, that long-term thing. Because ultimately, let me ask you a question, right? What's your long-term goal? What do you want to do with your savings?
To invest more into my passion.
Okay.
Right.
Well, tell me what your passion is.
Oh, well, I'm very passionate about my art, specifically my music, and that's something that I eventually hope will be able to keep my lights on. So I try to use the money that I've saved to reinvest in myself and into these artistic endeavors that I go through. That
amazing life you're going to build is going to be built on a foundation of strong financial decisions. And right now, 15% is just, it's in a wheel that's going round and round and round. Win, lose, win, lose, win, lose. It's almost like going to a casino and putting stuff on red and hoping that you win. Get rich quick isn't going to get you rich quick. But long-term planning and long-term stability is going to enable you to build towards that dream, which I absolutely love.
I appreciate that. And I think it's just a matter of me getting lost in my own head, trying to get there quick, as you mentioned.
Yeah.
So it's trying to be quick in terms of getting rich, and dealing with money in itself is a terrible combination. It makes for poor financial decisions. I'm aware of that. It's just I never learned. Hopefully I learned.
You've got time. Yeah. You've got time, okay? So what I really love is the fact that, you're 22 years old and you're already examining financial education. So there's lots of positives here. But let's also think, you're at the start of your journey. Let's recap, okay? Unexpected expenses. Let's start tracking those, and therefore you know how much it is costing you to be Joe each month. Then on top of that, you can realistically calculate what's going into those savings. Brilliant that you're thinking about making your money work harder for you, but 15%, Don't be burning that for me, Joe. Let's have a look at 5%. Play, but then put that extra 10% back into funding your long-term dreams. When you talk about those savings, those long-term savings, emergency fund in there, 3 to 6 months, so don't touch that. And then beyond that, start building long-term wealth and get on the road now. Exchange-traded funds, accounts that are offering you compound interest, things that will genuinely make money for you and beat inflation, but you're not burning it. You're not going into the casino and putting them on red. But other than that, old head on young shoulders, you're going to be perfect. And Joe, it's been a genuine pleasure to meet you on Your Money Matters today.
Thank you so much for having me. I really appreciate it.